The stock market crash of 1929 was a 4-day collapse of stock prices. It was the worst decline in the US history, and many people lost their lifetime savings. Welcome to the BHM Media channel. Today, we'll take a look at the crash of 1929 or the Great Depression. What happened, why it happened, and the consequences. We'll discover what went down almost 100 years ago. During the 1920s, the US economy and the stock market experienced rapid expansion. Stocks hit record highs in the great Hoover bull market, and the public, from banking and industrial magnates to chauffeurs and cooks, rushed to brokers to invest their savings in securities, which they could sell at a profit. The economy grew by 42%, average income rose by about $1,500, and unemployment stayed below 4%. It seemed like a nice time to be alive, so everyone wanted to get in on the action, and credit was available. Businesses and individuals borrowed money to buy stocks on margin. Buying on margin meant that an investor could put down 10 to 20% of their own money and borrow the rest from their stockbroker. This type of leverage was extremely risky because if the stock price fell below the loan amount, the stockbroker could issue a margin call requiring immediate repayment of the loan. Despite this risk, even banks were buying stocks on margin, and since no law prevented it, some used their customers' deposits to do so. People were so confident that shortly before the crash, on October 16, 1929, economist Irving Fisher famously proclaimed, "Stock prices have reached what looks like a permanently high plateau." On September 20th, the London Stock Exchange crashed when top British investor Clarence Hatry and many of his associates were jailed for fraud and forgery. The London crash greatly weakened the optimism of American investment in the markets overseas. In the days leading up to the crash, the market was severely unstable. Periods of selling and high volumes were mixed with brief periods of rising prices and recovery. Selling intensified in mid-October. October 24, 1929, Black Thursday. The market lost 11% of its value at the opening bell on very heavy trading. The huge volume meant that the report of prices on the ticker tape in brokerage offices around the nation was hours late, and so investors had no idea what most stocks were actually trading for at the moment, further increasing panic. Just a side note, ticker tape could only produce 285 words per minute. Several leading Wall Street bankers met to find a solution to the panic and chaos on the trading floor. This crash cost investors more than World War I and was one of the catalysts for the Great Depression. On Black Tuesday, October 29, 1929, investors were in a full-blown panic. 3 million shares were traded in the first 30 minutes alone. As investors tried desperately to communicate with their stockbrokers, phone lines jammed and Western Union telegrams tripled. False rumors that investors were jumping out of skyscrapers fueled the panic, and fistfights broke out on the trading floor. Stockbrokers called in margins and sold the stocks of investors who couldn't immediately repay the 80 to 90% they had borrowed, wiping out life savings in a matter of seconds. When the market finally closed, the Dow Jones had fallen 12%. It took 24,000 kilometers of ticker tape to record the 16.4 million shares that had been traded. To put that in context, the distance from Manhattan, New York to Sydney, Australia is a mere 16,000 kilometers. The market had officially crashed. The main factors that contributed to the 1929 crash were margin buying. Before the crash, nearly 40 cents of every dollar loaned in America was used to buy stocks, typically from margin buying. When the market started to take nosedives, brokers began to make their margin calls, and borrowers were often unable to pay up. When that happened, brokers simply sold those stocks, wiping out savings and increasing panic. Lack of legal protections. The legal protections we have today on bank deposits and securities transactions didn't exist in 1929. After the crash, banks were only able to honor 10 cents on the dollar because they had used customers' deposits to purchase stocks without their knowledge. Additionally, investors had no recourse to recover funds if their brokerage firm went out of business. The Federal Deposit Insurance Corporation and the Securities and Exchange Commission were founded in 1933 and 1934 respectively as part of President Franklin D. Roosevelt's efforts to restore confidence in markets under the New Deal. The other factors that contributed in the same way were overpriced stocks, the crash in London, news headlines, and Federal Reserve policy. A soaring, overheated economy that was destined to one day fall likely played a large role as well. The stock market crash of 1929 was a 4-day collapse of stock prices. It was the worst decline in the US history, and Irving Fisher's declaration 8 days prior to the crash went down as the worst stock market prediction of all time. Probably none of us got to witness 1929, but many of us did experience the crash of 2008, which we will investigate in the future. For now, we would like to thank you for watching and hope you enjoyed the video.